sign up and trade with Oenda via TradingView and get your feedback. All the tools you need for smarter trades, speedy executions.
I don't deny there's some strange evolutionary process going on, but mankind won't be destroyed. The fact that you and I are working here today is evidence of that.
Alright, hello everyone, welcome to the MTL stream. Today I'll be covering mainly on how to do data analysis and the FOMC outlook for the FOMC statement around 2 a.m. Right, I'm going to do a mic check first. Alright, so I don't think there'll be a lot of viewers for this particular live stream. So I'm just going to treat it like I'm recording a lecture or something like that. Alright, so firstly let's talk about the FOMC outlook for later. So let's go on a DXY. pure charts only. Ultimately, in my personal analysis on the Discord, I actually did mention that I'm aiming for the DXY to push even higher. Push even higher because, well, let's just use ICT uh, strategies and concepts to explain it first. Then I'll dive deeper into fundamental analysis. So more on the technical analysis side, if we go on the monthly time frame, we actually can see that we have a unfilled monthly fair value gap up here. And especially is a balanced price range. You see that this fair value gap actually overlaps with the other fair value gap. Hence, this is a not just a fair value gap, but we can also call it a balanced price range. So a balanced price range occurs when two fair value gaps overlap. And the nature of the fair value gap will follow the most recent fair value gap. So in this case, it's the down candle. So this will be a bearish balanced price range. So I do expect price to tap into this area here. So why? Just using one time frame alone, which is the monthly time frame, is not enough to determine why price is going to rise up there. So we have to drop down to lower time frames to determine. So on the weekly, what can we see? On the weekly, we can actually see this equal highs here. So I'm going to mark it out. EQH for equal highs. So usually when we see equal highs or equal lows, they tend to act as a form of draw on liquidity because based on what I teach, what I believe in, the entire forex market runs on this thing called auction market theory. So the whole idea of auction market theory is that because for a sort of order to process, you need a buyer and you need a seller. So there will always be bid and ask prices, right? So they must match. There has to be a sort of a fair value where both buyers and sellers can agree with each other. So at these equal highs here, we can usually see a lot of orders being placed because, for example, swing traders, let's say they went short here, most of them will place their stop loss above here. So this acts as an area of stop loss, which is a lot of orders as well. And we have other people who buy stops, so they'll place their buy stops above here as well. So let's say price breaks above here, they'll place their order. Hence, this entire region here, this equal highs, acts as a form of a liquidity pool. We see a lot of orders being accumulated up here, and hence is currently acting as our draw on liquidity because, again, the market algorithm operates such that it aims to pair the most orders together in the most efficient manner. So it's drawn towards liquidity. That's why we call this draw on liquidity. Right, let's go on the daily time frame. What can we see again? Again, we see this the daily time frame is the one that gives us the most information, especially for us intra-session traders. So over here, again, marked out the equal highs. We can actually see now it's more obvious, the liquidity pool here, especially with this wick over here as well, it's relative equal highs. So if you were a short seller, you would definitely place your stop loss like this, right? I mean, you would go short here, stop loss above the highs, and then you target somewhere maybe over here. Okay, this is a swing sell. I don't know who will actually sell all the way down there, but let's just imagine it as you're selling all the way down there. So usually what price does is, okay, let's see, in this case it reversed, right? It reversed, it went to over here. So some people hit break even, that's fine. But the ultimate goal is to ensure that everyone is ran out, okay? Because the market doesn't want you to profit from it, all right? The market is a game run by smart money, people with a lot of capital. Places like we have institutions, we have central banks. These guys run the entire market. Us retail traders, we are nothing to them. All they want to do is eat our money, and that is facts. I mean, there's nothing, there's no money. I don't earn any money from lying to you about that, right? That's how the market works. A person needs to win, a person needs to lose. So if banks and institutions are always winning, then who are the ones losing? Those people are retail traders like us, right? So they know how to engineer liquidity. They know how to sort of bait us into, induce us. Yes, the word is induce. They know how to induce us to set our stop loss at certain levels. So these equal highs here, you can actually see it as a form of an inducement. They're inducing us to place our stop loss there to only be ran out at a later time. Yes, Hi Xingjian, welcome to the channel. So yeah, it induces us to put stop loss there so we can get ran out next time. So when it gets ran out, we lose money, and smart money earns money. Alright, because for our strategy, we are always trading intraday, but remember this forex market is trillions of dollars. We are not the only ones. Intra-session strategies are not the only things that operate in the market. Alright, institutions are trading with other institutions again as well. They're trading against each other, trying to compete to make the most money. Alright, so all these are forms of inducement. They are baiting you out. So with that, I hope you guys understand what I'm trying to say. There's a lot of fake outs being created in the market for us to input more money and to inject more liquidity into the market. Alright, so this is our current target for now. The equal highs is where we want to see price run into. Furthermore, what is interesting is you can see that for the past few weeks we're actually in a consolidation. But a lot of people see this as unclean price action. But what do I see from here? I'll tell you what I see. So we both now know that we have a monthly fair value gap and a BPR on top. So that's our draw. So we have to use that to our knowledge to sort of build a context. So over here, this is the lowest low. We actually can see the consolidation over here. Okay, I'm gonna mark it out with a red box, right? Because we wanna make it more obvious. Alright, so we have two red boxes here, and these are two ranges of consolidation. So what ICT actually teaches is this thing called the market maker model. The market maker model is basically consisting of two sides of a curve. So a curve is like, I don't have a tool that I can use to draw a nice curve. Okay, this one works. Alright, so this is one side of the curve, right? Is 1/4. So the other side of the curve is, okay, that's the wrong side. Oopsie. Okay, I'm not sure how to flip it. It's my first time using this tool, so it's a bit wonky right now. There you go. Alright, okay. So these are two sides of the curve. Okay, let's make them equal size. So one side of the curve, we'll call it the buy side. The other side of the curve, we call it the sell side. So what happens in each side of the curve is we see a consistent buy or sell program. So let's name the left one the sell side of the curve, alright? And we name the right curve here the buy side of the curve. So what happens on the sell side of the curve is that we see price consistently go downwards in the downtrend. Alright, so this is where a sell program takes place. But price doesn't just tank like this, doesn't just go down all the way, because that doesn't make sense. If price was so predictable, all of us would be rich by now. So how does price go down from here? Well, to make it simple for you guys, in the sell side of the curve, we'll at first have of the original consolidation. This original consolidation is a phase where orders are being accumulated. Right? We're trying to build as many orders as possible. It doesn't have to be just short orders. Maybe retail traders are going long and institutional traders are going short. So this is the case for a sell side of the curve. In the original consolidation for the sell side of the curve, institutional traders will be going short, but they will be pushing price up at the same time to bait retail traders to go long. Alright, so this is the accumulation phase. Then, when enough orders are being accumulated for the short side for institutional traders, you will see a very, very big dump. And this dump comes almost without warning. If you're not familiar with ICT concepts, this one will see very random. It comes all of a sudden, you don't expect it at all. Or it could be a news driver. So news events like NFP or FOMC, such as today, which is what I'm expecting to happen. That's why I decided to link FOMC outlook and this concept together, because you are going to witness it for yourself. Alright, so original consolidation, it dumps all of a sudden, and there'll be another consolidation here. The same cycle occurs, and then you will see another dump. All right. So 1, 2, and then to the third dump. A third consolidation is not necessary if we have hit a specific point of interest. So this line here will be called a point of interest. Okay, to make this simple. In ICT, we call it PD arrays. But for this, we just put a point of interest. This point of interest can be anything ranging from an order block, fair value gap, or a breaker block. Something that indicates a lot of strength, a lot of orders will go to the bullish side. Alright, so when price enters this point of interest, we might see some slight consolidation, or we might witness a full-on reversal. And when it reverses, again, this is one side of the curve complete, right? This left side is complete now. This entire sell side of the curve is complete. We have hit our target, and now we are entering the buy side of the curve. So in the buy side of the curve, we can actually expect some form of a symmetrical pattern with the sell side of the curve. So in here, we have two original consolidations. So we can expect 2 or 3 consolidations to wipe out another point of interest. And I'll show you what the next point of interest is. So I'm going to draw it out. This is the first consolidation, second consolidation, and then it goes on. So what is this last point of interest? It is actually the original consolidation. So I'm going to mark it out. Right, so the original point of interest is the original consolidation is the next point of interest. So most traders who understand this market maker model is only able to trade one side of the curve because we have to see the left side of the curve occur first before we understand what's going on and we can trade the right. Experienced traders can spot this entire thing before it has ever even happened. However, I myself am also still in the process of learning how to spot the entire thing. I've had some successes with it, I admit, but it is not perfect. I am not a perfect trader at this thing yet, this concept yet. But I've seen it play over and over again through my market experience, such that I can confidently tell you that this thing does exist. You can definitely spot one side of the curve, and you can leverage off of this entire leg up by just trading one single direction. Right? Don't counter trade the trend. You know, they always say trade with the trend. This is how you identify the trend. All right, is that clear for you guys? Can you guys let me know in the comments whether this market maker model makes sense to you? Because I'm going to move on to a real life example now. I'm going to show you how it looks like on the charts itself. Nice. Thanks for the response, guys. All right. So now we're going to move on to the real life example of the curve. I hope you guys can remember this 1/4 circle thing. All right. So I'm going to leave this here and I'm going to move on to the real life example. So pertaining to what I have just said, all right, can you guys see what's going on? Can you see it now? Does it make sense now? With the original consolidation actually being up here, but for now, the first target, the lowest hanging fruit target, will be this monthly fair value gap that I've identified. All right, so yes, we may expect price to actually run the highs here. We may expect price to run the highs here, but you know, because that is still very far away, we are on the daily time frame. That may take months to happen. So our very, very nearby target is actually this equal highs here into the monthly fair value gap. Right? Because there's really nothing much for it to attack down here. We are in the buy side of the curve right now. If you don't believe me, you can go and watch ICT's video yourselves on the market maker model. It is the exact same thing that's happening right now. Alright? And the best part is this technical analysis aligns with the fundamental analysis that I have for you guys, because this aligns with a lot of market sentiments as well. Alright, so what can we expect now? We have the original consolidation here. We have two consolidation phases here. We actually hit some point of interest here, and then we saw a complete reversal. We can expect price to move to the upside. All right. So this is my current bias for the market maker model on the dollar index. So the dollar is the king of all of forex. All right. Every major pair actually, every major pair you trade with is correlated to the dollar. So how the dollar moves will affect how that pair moves. Most pairs are inversely related to the dollar. So for example, in the Discord, I trade mainly the Euro USD and the GBP USD. These pairs, the USD behind, they are major pairs, but they are inversely related because the USD is behind. But if we are trading USD CAD and the USD is in front, then it is trading in the same direction. So if DXY goes up, USD CAD will go up. If DXY goes up, Euro USD will go down. Alright, so with that in mind, that is the correlation between pairs. So now that we know that we're going to expect it to go up, I'm going to show you the fundamental analysis side of things. So fundamentals, okay. How many of you guys are familiar with the current economic situation now? Just just type in the comments, let me know. Do you guys keep up with the economic news? Alright. Okay, so let me just explain what's the current economic condition. So for the entire of 2023, we actually have rising interest rates, right? So when rising interest rates come about, what is the point of that? Is to combat inflation. Because when borrowing rates are very high from the banks, the reason why it brings down inflation because it reduces spending power on all consumers. Because if with high interest rates you have to pay back even more every single month, or your monthly installment, that kind of thing. Yeah, so people can't afford to spend. And when people can't afford to spend, inflation goes down. Inflation is driven by spending power. So the relation is this. Let me type it out. So higher spending power, so higher spending power equals to more inflation. More inflation equals to higher interest rates. Because to the Feds, if the interest rates that are at its current peak, let's say now is I think 5.5%, at this peak, if inflation is still rising, then to the Feds it'll be like, oh, our interest rates are not high enough. We have to increase it further to combat inflation because inflation is not slowing down. Alright? Their target right now for inflation is 2%. The Feds want to bring it down to 2%. So if by the next CPI we don't see any improvements, we can expect interest rates to remain as high or even increase. But an increase is very, very unlikely because it's currently way too high. A lot of people actually are like suffering from this high interest rate environment, especially for the property market and such. Alright, so this is the correlation. So higher interest rates or slash remain the same slash no rate cuts. Okay, these three sort of bring about the same outcome in forex. So what does that indicate? Higher dollar or DXY. This is the correlation. So higher interest rates or no rate cuts or it remains the same, which is the announcement that we are waiting for today. Sorry, let me cough a bit. Let me mute myself first. Wow, very thirsty. Okay, so higher interest rates or they remain the same or no rate cuts will basically give a higher dollar, which has been what has happening for the past 2023. We can actually see the entire 2023 from here. as interest rates kept rising, price of the dollar kept going up and up and up. It's such a clean trend, you know. And then it went down because towards the end of the year, everyone had this expectation that interest rates would be cut. All right, so the current market sentiment is that they want interest rate cuts to come fast. However, remember I said that the interest rates increase because people are spending more, right? So what is the inverse of that? Interest rates decrease because people are spending less, right? And when people are spending less, what does that indicate? That indicates some form of not a very good economy, right? That means the economy is suffering. That's why they can bring down interest rates because they are sure that inflation will not increase because people do not have the same spending power as before. Right? So does that correlation make sense to you? You guys want to let me know in the chat so I know you guys are. But just feel free to ask any questions because I'll really take time to explain this to you. All right? Okay, good. I see that two guys have responded with yes. That's good to hear. Okay, so moving on. The current market sentiment now is that people are expecting interest rates to come in as early as possible. Interest rate cut. They're expecting this interest rate cut to come in around as soon as January to March. But if that is the case, right, that means this must indicate if the Feds are willing to cut interest rates, that means we are facing some economy issues. Things like recessions. If you look around you right now, in your own country, yes, we are facing some form of um, economy issues. However, most of the countries are actually able to sustain. You know, think life is still going on as per normal. Market analysts say that we are entering a recession soon, but again, those are just predictions. But if you look around you and see our country is sort of like doing well, like for example the US side, you know, we actually see the economy is still a very bullish market, right? Recently the stocks pumped up incredibly high. We see the Nasdaq, we see S&P 500 hitting all-time highs and everything. If the stock market is hitting all-time highs, then doesn't that just indicate like a very good economy, that the market is still growing? So if the market is still growing, why would there be an interest rate cut? Right? So US stocks still growing. This equals to market / economy is doing well. And if the market is doing well, why would there be an interest rate cut? You know, it doesn't make sense for there to be an interest rate cut because if the market and economy is doing well, people are able to put in money into the stock market, that means spending power is there. People still have money to spare to put into the market rather than saving up for necessities, you know, spending less outside. Consumer spending is still a problem in the US. That means inflation will not okay, basically inflation does come down, but it's not coming down at as quickly as the Feds want. So what's the only solution for that? If the market and economy is doing well, then they cannot go ahead with rate cuts. Their only options remain with interest rate increase or remain the same. So this option here, higher dollar, right? Where else do we see the confluence as higher dollar? In the market maker model. This is the dollar index. We are expecting a higher dollar on the market model itself. This is the fundamental analysis. In this period of time, the fundamental analysis and technical analysis have gone in sync with each other. that gives me a very strong confluence that I want to see the dollar pump up even more. Again, this is all prediction. These things have happened before, and sometimes I can be wrong. This is not 100% thing. This is just an analysis. Alright, do you guys see the correlation here now? Fundamental analysis meets technical analysis, both of which are pointing the DXY to the same direction. Yes, so for EU, we can only expect further bearishness for the Euro USD and other foreign pairs as well. So let me show you what I have on the Euro USD. Alright. So now we have this entire narrative on the dollar. Let's go on the Euro USD. Okay, let's ignore this graph here for now because this is something else I want to show you later. This is a data that only institutions use. You don't really see a lot of retail traders using it. So on this chart, you guys notice the IBDA 20, IBDA 40, and IBDA 60, right? So we are currently going with the narrative that the market is operated by an algorithm. And as all algorithms do, they need a specific set of data to look back on to sort of decide their next move. Because the data isn't random. It's a bit dangerous if the algorithm we have is very random, right? Yeah, so right now, this algorithmic theory that I'm going to teach you is how the Euro USD algorithm works. And I'm going to show you how this algorithm theory corresponds to what I just taught you on the DXY. Right? So we can expect downwards move, right, for the Euro USD. And we can expect higher upwards move for the DXY. So on here, I marked out every single very obvious swing point for the Euro USD. So what is IBDA 20, IBDA 40, and IBDA 60? These indicate a look back period. A look back period basically means, let's say today is 31st January. The algorithm is referring to the past 20 days to determine which points are the fractal swing points, which points are the important points that it wants to run. So let's say if we're in a sell program, we will constantly be taking out the lows, right? If we're in a buy program, we'll be constantly taking out the highs. So I'm going to show you this indicator. This marks out the IBDA 20, IBDA 40, and IBDA 60 perfectly. Right? This is a very rare time where they all align. Okay, so these are the main key points that I want to see run out because we are in a sell program. The most important one being the IBDA 20, which is the next draw on liquidity here. So I want to see price actually run this here because why I'm not using there's an anchored one and there's a variable one. Variable one basically follows you every day. You can see that the variable one doesn't make sense because we just formed the low. Yeah, sure, it will get taken out if the FOMC prediction gets to be correct, but if we're going to look back 20 days, 40 days, and 60 days for the low, we can only see the 40 days and 60 days one making sense, right? The 20 days one doesn't really make sense. This rectangle is like in the middle of nowhere because it's the entire consolidation period. So this one is not very relevant. I can't really give you much information on this because it's completely wrong. But as for this one, which is anchored, it means that I have decided that 28 December is where the change in the delivery occurred. That means we transition from a bullish trend to a bearish trend. So you will set your data start point from here. And then the algorithm refers to 20 days back, where is the next swing low? Over here. 40 days back, where is the next swing low? Over here and over here. 60 days back, where is the next swing low? Over here. And you can see that it's very clearly a swing low over here. You can see that the time and everything aligns with the swing low perfectly, See, 20 lowest point here, 40 lowest point here, 60 lowest point here. But if you change to the non-anchored one, what's this? It's a bit weird, right? It looks a bit weird as compared to the other one. Agree? So by the way, the word IBDA, right, actually stands for Inter Bank Price Delivery Algorithm. So this is what IBDA stands for. The Interbank Price Delivery Algorithm. It uses the past 20 days, the past 40 days, and the past 60 days to determine draws of liquidity. So in a sell program, you want to see these draws on liquidity being ran out. So your most extreme look back will only be up to 60 days. Okay, and you have to learn how to identify where to determine your start of the 60-day range and the start of the 20-day range, etc. So to sum it up, okay, it's a very complicated concept that I'll eventually teach in my mentorship, but I'm going to give you a very quick summary on how to use this interbank price delivery algorithm. Is that we understand that there's a premium and discount ray, right? That means this is the 50% line and the premium is here. Sorry, this is the wrong one. Yeah. We see that there's a premium and discount. The red being the premium and the green being the discount, right? So this IBDA range coincides with the dealer's range. This entire thing is called the dealer's range. So the lowest of the 60-day look back to the highest of the 60-day look back will be your dealer's range. And from there, you will keep shorting if you are in a premium. And as you can see here, from up to 60 days on 60 days look back, we are still in a premium. We are bound to go lower until we hit a important PD array in the discount region. So for now, we are still in premium. We're still in the almost near equilibrium already, but we're still in a premium. That means this tells us that we continue to short Euro USD until it enters a discount range. Correct? Make sense, guys? Just respond to me in the chat. Let me know if you are keeping up. Any questions, just feel free to ask me. I'll stop and explain to you. Any questions? Nice. Okay, good. I'm glad you guys are keeping up. Okay, so this tells us that the direction to go down is bearish trend. To take out this liquidity and this liquidity point, for the IBDA 40 and IBDA 60, we have to see what the reaction is like after taking out the IBDA 20 to then determine if it will further be ran out. Because this is in a very, very deep discount. We might not even run the liquidity on this. That's why ICT always says the most important IBDA look back function is look back at the IBDA 20. Right? So IBDA 20 is your most important one as compared to the 40 and 60. For the 40 and 60, it is more important for traders who are doing swing trading, holding for multiple weeks and multiple days. Those are more relevant to them. But you know, the style that MTL teaches is more of the intra-session, intra-day. We hold for like 2 to 3 days. That's the maximum. So in this scenario, the IBDA 20 is the most important. The reason why I use IBDA 40 and IBDA 60 is to do top-down analysis, to illustrate to you guys the entire concept of the interbank price delivery algorithm. Okay, so now you see these gray boxes here, right? What are they? You might be wondering, okay, we have the look back function, so any period in front of this is the look forward function, otherwise known as the cast forward function. So what the cast forward function states that, okay, it takes 20 days to form this entire range here. It takes another 20 days to deliver from the top to the bottom. Sometimes there may be delays, but note this, from this range here, this start date here of the entire dealing range, we have reached from the top to the equilibrium point. This is exactly at the equilibrium point now. And now we are about to enter discount. And we want price to enter discount before seeing any form of bullishness whatsoever. And what do we have today? We have FOMC, right? You see that at the 20-day cast forward mark, we exactly reach equilibrium point. So in the next more 20 days now, what can we expect? We can expect price to go further down. You see what I mean? You see how time and price is aligning now? 20 days forward, you see price deliver all the way. In the next 20 days, where can you expect price to go? You can expect price to run out the IBDA 20 low and this other swing low over here that resides within a discount range in the IBDA 40 range. Do you guys understand that? Do you guys understand what I'm saying? Do you see how the time factor is very important now? Yeah, because the entire point about algorithms and how ICT works, right, is time and price. Everyone keeps saying this time and price theory, right? But a lot of videos about ICT only goes on about price, only goes on about patterns. Patterns like OTE or breaker blocks. You know, what use are those patterns if you don't put a context behind it? And that context comes in the form of price. Right? What is the point of all these patterns? You know, if I trade solely patterns, right, then every single order block would be valid. Every single fair value gap would be valid. And we all know that that is not true. You know, we have to wait for some form of reaction to happen. And we all have this thing called kill zones, right? You guys know what kill zones are. These are specific timings in the market to trade. The only reason why we trade during those kill zones is because we have a context behind those patterns. We have time and price aligning together, which is what is happening over here on the higher time frame. We are aligning time and price together, right? So even though FOMC may not give the push downwards, we still have NFP on Friday. We have two incredibly volatile news coming up this week. We can definitely see some form of a wick to take out these liquidity points here. So in the next 40 days, we can expect, in the next 20 days, we can expect our points to be ran out. And then we wait for another reaction or a confirmation that price wants to go lower to take out the IBDA 40 and 60. So one golden thing that I always remember from the mentorship program is that if you are in a sell program, if you are bearish on the institutional order flow, you want to look for every single swing low to be taken out. So every time you see a swing low form during a sell program, you want to see it being taken out. Swing low form, taken out straight away. Swing low, taken out by this big candle here. Swing low, taken out. And all the swing highs, they're pretty much like maintained there, you know. Because if a swing high is broken, then you maybe have to reconsider, oh, is it a market structure shift? Are we experiencing some form of a change in delivery state now? So as long as in a sell program you keep seeing swing lows being broken here and there, and no swing highs are being violated, then you are still in a sell program. And you will keep shorting it until you see a confirmation of a reversal. There is no reason to change your bias without seeing a confirmation. As traders, you are to trade what the chart tells you, not trade what you think the chart will look like. Unless you have this interbank price delivery algorithm in your like PC or something, which is impossible. So as of now, all this is still a prediction. This is just a very, very, very accurate prediction that I'm pretty sure is very close to how banks actually trade and utilize their algorithms to determine what price to run. Where should I run price to? Alright? Any questions so far? Nice. Okay, no questions so far. That is good to hear that you guys this is actually crystal clear for you. Okay. Because I actually have a lot of concepts to teach you on and so many confluences as to why price is supposed to be bearish. But I think due to the lack of time, I'm unable to teach you all the concepts at once. And I think a lot of people might copy what I say as well for their own YouTube videos and all. And I rather that not happen because I spent a lot of time watching ICT's private content. Things that are not released to YouTube yet, or maybe it will never be released. So this information is privileged. It's not entitled. I hope you guys will use this information wisely. I've given you the names of these confluencers here. You can search it up yourself. Alright, so that's all I have for you for the FOMC outlook and the institutional data analysis for today. There will be more. There will be more live lessons, more educational lessons like this. And if you want to be able to participate in these lessons, maybe I will do it in Discord while streaming it to YouTube at the same time. And then you can ask questions directly on Discord by just opening your mic. I think that will be a very nice interactive lesson for everyone. Alright, so that's all I have for you today. I hope you guys actually enjoyed what you have learned. And I'll see you guys next time.